For the past 100 years, government officials and bank CEOs have insisted that new policies, new rules, new laws, combined with greater market discipline, resolution schemes, and enhanced supervision will ensure that future financial crises, should they occur, will be more effectively handled. In the U.S., the creation of the Federal Reserve itself and then the FDIC were distant examples, or are distant examples, in which such assurances were given to the public. More recently, the 1991 U.S. FDIC Improvement Act, FDIC, was to end public bailouts of failing banks, and in particular, they were to end too big to fail. Such assurances seemed even more significant following a 1991 Treasury report that found that too big to fail resolution policies used for 6 of the largest banks cost the taxpayer in current dollars $5 billion. If only the cost of the 6 largest bailouts in this recent crisis were just $5 billion. But unfortunately, and this is maybe, I think, the key, incentives matter, and the incentives towards risk among the largest financial firms remain basically unchanged from the pre-crisis times. Despite the enormous regulatory burdens placed on financial firms post-Dodd-Frank, they continue to be incented to leverage. With time, we can be confident that our financial system will once again, I think, become more highly leveraged and the economic system become more fragile as a result. So the point is, to change outcomes, you must change drivers or elements of it, and that's what I'd like to mention. First of all, the idea is that with the safety net, you change all the incentives that are in the game, and you drive towards moral hazard, and you drive towards leverage around that moral hazard, which creates its own set of consequences in time. So as I've addressed this and talked to many people about it, and I'm very interested in your reactions, but assuming we can't eliminate the safety net, and I think that will be most difficult, then there are 3 things that I think have to be done at a minimum. Now, there may be more things that you may have better ideas, but these are 3 that I have. First of all, I think it's important to recall that following the Great Depression, when the safety net was greatly expanded with FDIC Insurance, which was in addition to the discount window that had already been established with the Federal Reserve, I think people did realize, given the studies that have been done about the Great Depression, that you needed to at least address some elements of the moral hazard that was being created. And so the trade-off was, we will put FDIC Insurance on the commercial banks because they are so important to the payment system, to the deposit taking, and to the intermediation process around that, from depositor, saver, to borrower. And therefore, they forced out the higher risk investment banking, broker-dealer activities away from the safety net. And for several decades, partly because of the experience of the Great Depression, but also because I think of the structure, we had relative stability in our system. So the point is that then we came, with that stability, people began to say, well, it'd be more competitive if we allow investment banks and commercial banks to compete more directly, the consumer will be better served, and so we will break down those barriers. And in doing that, you not only created perhaps what you intended in the sense of more competition, but you also expanded, if you will, the coverage of the safety net to ever more risky activities. And the consequences of that are that you leverage more of the industry around the advantages of having the safety net, of not being held to a very strict set of consequences should you not engage in safe practices that the market could identify. So it didn't take even a decade, literally, for the industry to greatly leverage up, to engage in ever-increasing risky activities, and eventually we came to the crisis of 2008. So my point here is that if we're going to continue with the safety net, and I think we are, then you have to think about narrowing its coverage to what it was intended to cover, and that is the commercial banking industry narrowly defined, the payment system and the intermediation process around that. And that is a big chore, I realize, but if you don't do that, then you are on your way to making them officially public utilities or nationalize them because your safety net is at extreme risk. So we need to narrow it, and that's why I proposed in a working paper to move out the broker-dealer trading activities into separate corporate entities in the sense of spinning them out to the shareholders as separate corporate entities so that you reestablish the narrow coverage of the safety net, or at least attempt to do so, and I think in that way provide greater safety. Now, I am often told that the largest banks were not the cause and that I have this wrong, and that may be the case. But when they point to Lehman Brothers as a narrow bank and therefore proves the exception, I say, in my opinion, Lehman was a commercial bank in every sense. Number one, it had very short-term liabilities, deposits called money markets. They were not marked to a net asset value on a daily basis. They were understood by most consumers, at least, to be deposits, and they were treated as deposits, and it wasn't a whole lot different, although it was on a wholesale basis with the repo market, especially with the bankruptcy exemption that allowed you also to take long-term assets and secure your overnight deposits with those assets. It only made the vulnerabilities greater. And there was, I think, an implied guarantee as these institutions build in complexity, build in size, that the government would in fact take them over. And that moral hazard then allowed them to leverage up to incredibly significant degrees. So that's number one. Number two, the recipients of the TARP in that room were mostly some of the largest banks. That doesn't mean they were going to fail, but they were clearly at the benefited from the taxpayers' support, and I think would have had more problems should they not have been helped in that TARP arrangement. So you need to narrow the safety net. Number two is we need to rethink the capital approach. I'm not a supporter of Basel, everyone knows that, because it is too complicated and too easily gamed as it's introduced. With that much complexity, the whole idea is to remove and to shrink your risk assets so that your capital ratios go up. Under Basel I, I think the ratio of risk-based to total assets was around 75%. Before 2007, it had shrunk to just over 60-some%, and that's the whole point of the exercise for many of those institutions. And when the crisis was emerging in 2007, the advertised capital ratios of the largest banks, total capital risk-based assets, was around 11%, when the tangible, that is the capital with all the deferred tax benefits, the goodwill, and so forth, were out of the balance sheet, that ratio was less than 3%, less than 3 cents for every dollar of assets to absorb loss. And therefore, you could see why, when the crisis occurred, the industry imploded, because you had to shrink your balance sheets to survive, have any chance of surviving. And that's exactly what happened, and it actually hurt credit. So we need to simplify that, and I think we ought to have a measure that's easily calculated, understood, and enforced. It has clarity, and that's a tangible capital ratio, because that's all that matters in a crisis. If you ask most fixed income managers what they look at, it's tangible capital. That's what they rely on. That tells them how strong or weak it really is. So we need to go to that system globally, and I think the debate at Basel should be what the level should be in tangible and what the transition period to that level should be. And it is striking when they say it would have an enormous effect. It would have a beneficial effect, I think. The top 10 banks in the United States have a tangible equity capital ratio, the tangible assets ratio of about 6%. But the top 10 banks just under 100 billion have a ratio that's over 9%. The top 10 that's under 50 billion have a ratio that's over 9%. And the community bank has a ratio that's nearly 9%. So most banks, not the majority in terms of assets, but most banks would be very close to a 10% level out of the box. The other point of this is when you go back before the safety net was created and you look at what the market demanded, the average capital, tangible capital, equity capital to assets in a period before 1914 and in a period just after the Great Depression was 13 to 16%. And therefore, you can see what the market demands when you don't have the safety net propping up and creating the moral hazard. The final thing is, all right, if it's a minimum capital ratio in these narrow commercial banks, then what's the right with all these risks and the change in of the nature of the industry? My point is there that you need to, if you will, reestablish bank supervision as a tool. Remember, it is the third pillar of Basel, as a tool to identify risk. I think today it's too, it skims the surface only. There are methods, and not just the stress test, but there are methods to examine the quality of the assets by sampling across the industry, estimating what the condition of those firms are, and then assessing additional capital should they have a higher risk profile. And there are ways that we do that now, and we can do it more, I think, specifically if we decide to use that tool more vigorously than we have in the past. So I think it's extremely important that we rethink how we're looking at this industry. We will never end financial crisis. Capitalism and fractional reserve systems are in themselves volatile. But the question is, how do you work through those crises? Should you have the government be there in every case to bail out? If so, then nationalize them now and get it over with. Or do you want the market to drive? So if you prefer the latter, you have to narrow the coverage, increase the ability for the market to identify and deal with the crisis without the government being as much involved as it was in the last crisis. So those are my thoughts on the topic, and I will look forward to the discussion that follows. Thank you all very much.